Okay, hey everyone, this is Tamara. Okay, so let me go ahead and take myself off. So, hey everyone, Tamara Inzunza here of Realty One Group. I can't even think of my. Hey everyone, Tamara Inzunza here with Realty One Group Capital in Alexandria, Virginia, and I am bringing you the February housing market update. You know, there is so much going on right now. I just want to make sure that I show you what's happening so you can see and you can understand, and also hopefully this will help you make the best decision for you and your family. So let's go ahead and get into it. Let me take myself out. So I wanted to start off with an update on interest rates. So, you know, with my 24 years in real estate, I got to tell you, I've never seen the rates in the threes. And when they went down to the twos, I was doing a huge double take along with so many of my colleagues. It was truly historical. So how long will the low rates last? Here's a quote from Chief Economist of the National Association of Realtors, Lawrence Yun, and he says, home sales could possibly reach 8 million if we had more inventory. Mortgage rates should remain very low through 2021, although we may have seen the lowest rates already. And let me show you what he's talking about. So this will help put things into perspective. So this is a snapshot of the 30-year fixed rate from January 2020 to today. Now there's a lot of demand in the market, a lot of activity, and we're seeing the rates start to creep up. So keep in mind, this is exactly the way rates are supposed to behave. As the economy improves, interest rates do go up, okay? So have we seen the lowest rate ever? It's hard to say, but it may very well be that rates in the twos are in the rear view mirror. Okay, so second, I am seeing a lot of online groups, a lot of chatter. Not only are people frustrated with the current market and how challenging it is to get a home, believe me, I'm out in these real estate streets with my buyers as well, but I'm seeing the comments, wait for the foreclosures, they're coming soon because of all the people in forbearance. So I'm seeing that comment quite often. So I want to show you the real deal when it comes to people who are waiting for the wave of foreclosures to happen. So this is information from the Mortgage Bankers Association, okay? It's showing you the cumulative exits for the period from June 1, 2020 through February 14th, 2021. So if you're one of the homeowners in green, okay, you were in forbearance, but your mortgage is current, not late, you're out of forbearance, okay? So of the green, 27.9% were cautious, took advantage of the option, but actually continued to make the payments. So they didn't get laid off. Perhaps they were concerned about the possibility of a layoff, but they had the money and they continued to make the payments even though their mortgage was tagged as being in forbearance. 7.5% actually paid off their loan. So they took their mortgage balance, they wrote the check, and they now own their home free and clear with no mortgage, okay? And 15.4% were behind, but now the mortgage has been brought current, okay? So of all of the people in green who were in forbearance, 50.8%, they are all paid and current and will never come to the market, okay? They won't come to the market as a resale. They won't come to the market as a foreclosure. And I want to stress this because a lot of you, particularly when you're first starting your real estate search, you start out, you know, you're checking multiple websites feverishly because you're trying to find that one property. You're trying to beat another buyer to another property where you won't have to compete, and you may come across an address that says pre-foreclosure. And this is why we say that is not a true indicator of a home going to foreclosure or coming to the market simply because simply because a homeowner is behind on their payment. As we've learned, late payments do not equal foreclosure because in Virginia, the homeowner always has the option to bring the loan current. Okay, so let's move over to the blue slices. So in the blue slices, you see 25.8% now in loan deferral and 7.8% in loan modification. So we have 33.6% of homeowners who were in forbearance. They're currently in some sort of repayment plan. So believe me when I tell you, the banks do not want these properties back, okay? Banks are not in the property management business, okay? They are in the lending and banking business. So just like the option of forbearance wasn't on the table during the last recession, neither were a lot of the loan deferral and modification options that are available now. And it just makes good sense to keep families in their homes if a repayment plan can be reached. So again, the section in blue, the homeowners in blue, these homes will never come to the market. Again, not as a foreclosure, not as a traditional resale. These homes will never come on the market. So that leaves us with the red slices, where you have 13.8% of homeowners without a loss mitigation plan and 1.8% who may do a repayment plan if the income is there to support it. Otherwise, they may be looking at a short sale or a deed in lieu of foreclosure option. So keep in mind that if the bank offers that homeowner a short sale, that means they still have time to bring the home current, okay? So this is the information that I want you to have. This is the information that I want you to share when you are part of these conversations with friends and families. And more importantly, this is the information that I need you to have when you are making a decision of whether to buy now or to wait. But now if you're saying, but still, what if those homes did go into foreclosure and went on the market? Wouldn't that help? So let's take a look at housing inventory at the start of each year since 2016. So this is a graph of the Januaries from 2016 to 2021. So if we took the homes that were in red in the previous slide and we added them to the current inventory, we are still at a housing shortage. We're not even at the levels of last January or any of the previous Januaries since 2016. So that means that the foreclosures would easily be absorbed into the market and bid up, just like a traditional resale. So the likelihood that you would be getting a quote unquote deal or getting a home significantly below market value, it's just a really, really long stretch, okay? Now, for my homeowners who are on the fence about selling. Now, in one of my last videos, I said that the big word or big takeaway from 2020 was the word equity. But I also want to put into perspective what it looks like when you hear us say low inventory. So take a look at the inventory levels or months supply of homes nationally. You can see this is January and February of 2020. You can see what circle is that sweet spot. And right now we're in another sweet spot, even a sweeter spot for selling homes. The rule of thumb is when you want to sell something, you want to do it when you have little to no competition and you have a lot of demand or a lot of buyers who want what you have. So right now we're in what I like to call a hyper seller's market. So looking at the local stats, in Alexandria City, we have less than 1 month of inventory of homes. We're at 0.93%. Getting further out into the suburbs of Fairfax County, we're even lower at 0.67%. And take a look at Prince William County. This is unheard of, 0.26 months of inventory. So if you're looking at this, if you're watching and you own a home in Prince William County, please call me so I can help you sell it, okay? So we are definitely in one of the sweetest spots in over 20 years to sell a home right now, okay? I want to show you this quote, again, from Lawrence Yun, the chief economist of National Association of Realtors. And he says, a typical homeowner in 2020, just being a homeowner, they would have accumulated around $24,000 in housing wealth. So when you have price appreciation, that is how you build equity. Not only are you paying down your mortgage, but because of market conditions, your home is increasing in value. So let's take a look really quickly at the house appreciation for the final house appreciation numbers for 2020. So we have the Federal Housing Financing Agency, or FHFA. they came in at 10.8%, CoreLogic at 9.2%, and then the S&P Case-Shiller Index at 10.4%. So that's what we saw nationally. And this is going to tie into a question. Erica, thank you so much for texting your question. Erica says, so if interest rates go up and buying slows down, can values be sustained? So Erica, I think a good way to show this is to start with a visual on how price appreciation coupled with rising interest rates affects the mortgage payment. And I'm going to try to do my best to tie all of this in together. So let's say you were in the market to buy a home a couple of months ago in November of 2020, and you were looking at a home with a list price of, or sales price of $400,000 with an interest rate of 2.5%. Your mortgage or your principal and interest specifically would have been $1,580.48. So fast forward a couple of months to today, we're using the lowest appreciation, which was by CoreLogic. So that same house, if it increased in value by 9.2%, that home is now $436,800, okay? And it's very possible, particularly if you're in Prince William County, that home is now worth $436,800. And with today's rate of 3.3%, your mortgage or principal and interest would now be $1,841.57. So that is an increase of $261.09. So I want to point this out to say rates in the threes and then in the twos brought significantly more buyers to the market, okay? So on the flip side, whenever rates go up, that will automatically knock some buyers out of the market, okay? And when that happens, you'll see slightly higher days on market. Instead of maybe 30 offers on a house, you may see, maybe 3 to 5 offers, maybe 6 or 7. And the escalations or the offers above list price likely won't be as high. So that's going to slow down the rate of appreciation. But here's why no one is predicting negative appreciation. The supply of homes is just simply too low to keep up with demand. So a quick reminder, here's what it takes for us to get to a neutral market. So we need to have between 6 and 7 months of housing inventory in order for us to be considered a neutral or balanced market. So not a seller's market and not a buyer's market. So here is where we stand in Northern Virginia. So for the past 10 years, we have always been in a seller's market. We have yet to break the 4-month threshold of inventory. So Erica, if rates go up, what I see happening is a slowing down of the rate of appreciation, but not so much a drastic decrease in home values. So guys, I hope that makes sense. I love it when you text me and message me and DM me your questions. Please continue to do so. If you have any specific questions or if you would like me to do a deep dive in your neighborhood, just let me know. You can always find me on social media at All Things Moving to Nova. So thank you so much for watching. If you found this helpful, please like it and share it and comment below with any questions that you have, and I will do my best to get back to you right away. Thank you guys, and I look forward to helping you make that move.